I need you to stop whatever you're doing and pay very close attention to what I'm about to show you. Because right now, at this exact moment, something is happening in the silver market that most investors won't recognize until it's far too late. And I'm not talking about missing profits. I'm talking about watching your position get systematically dismantled by forces you didn't even know existed. This isn't speculation. This isn't theory. This is happening right now. If you're holding silver or planning to buy, the next 15 minutes could be the difference between making the trade of your lifetime and becoming another casualty in a game you didn't even know you were playing. Silver is trading at 84 or 11 per ounce as I record this. That number looks stable, safe, like we're in a consolidation phase before the next move higher. But beneath that calm surface, institutional players with billions in capital and decades of experience are setting a trap so sophisticated, so perfectly engineered, that by the time retail investors realize what's happening, the damage will already be done. And here's what should terrify you. This trap doesn't require silver to crash. It doesn't require the bull market to end. In fact, this trap works best in a raging bull market where everyone is convinced they're going to get rich. Michael Oliver, the analyst whose work correctly identified the 1987 crash before anyone saw it coming, who called the copper supercycle years before it happened, just sent an emergency alert to his private clients. And the language he used isn't about targets or price projections. He said, and I'm quoting directly, "The trap is being set in real time, and most participants won't realize they've walked into it until the door closes behind them." Those aren't the words of someone trying to scare you. Those are the words of someone who has seen this exact pattern destroy investors in every major commodity bull market for the past 40 years. What makes this moment so critical, so urgent, is that the trap only works if you don't see it coming. Once you understand the mechanism, once you know what to look for, you can position yourself to profit from it rather than become a victim of it. But you need to understand it now, not next week, not when it becomes obvious. Because by then, the trap will have already closed and there's no escape once that happens. In the next several minutes, I'm going to expose exactly how this trap works, who's setting it, and why right now, this week, is the critical moment when everything is being put into position. I'll show you the 3 warning signs that appeared in the last 72 hours that confirm the trap is active. I'll walk you through the psychological mechanism that makes this trap so devastatingly effective, and most importantly, I'll show you the only way to protect yourself and actually profit from what's coming instead of being destroyed by it. But I need to warn you, what I'm about to reveal will contradict almost everything you're hearing in the silver community right now. It will challenge your assumptions. It might even make you angry because it's not what you want to hear. But I'd rather you be angry and protected than comfortable and destroyed. Let's start with what happened between Tuesday night and this morning that confirms the trap is now fully operational. The first piece of evidence appeared in the repo market, a corner of the financial system that most investors never look at, but where institutional players reveal their true intentions. Between Tuesday and Wednesday, the overnight general collateral rate for silver-backed repurchase agreements spiked from 4.2% to 7.8%. For those unfamiliar with repo mechanics, this is essentially the interest rate that institutions charge each other to borrow against silver collateral overnight. Why does this matter? When repo rates spike like this, it means institutions are suddenly unwilling to lend against silver collateral at normal rates. They're demanding much higher compensation for the risk. But here's the critical question. What risk? Silver prices are stable. There's no crash happening, no crisis. Yet, institutions are suddenly treating silver collateral as substantially more risky than they were just 24 hours ago. This is the first sign of the trap. Large institutional players are quietly reducing their exposure to silver collateral, preparing for something they see coming that retail investors don't. They're not selling silver outright, which would be obvious in exchange data and would tip off other market participants. They're doing it quietly through the collateral markets, repositioning themselves in ways that most people never see. The second piece of evidence showed up in the options market, and this one is far more sinister. On Wednesday morning, a series of large block trades hit the market. Someone in the size suggests a major institutional player bought 85,000 put option contracts on silver with strike prices of $65, $60, and $55 all expiring in April and May. That's options betting on silver, declining 15% to 30% from current levels. The notional value of these put purchases exceeds $2.1 billion. Now, here's where this gets interesting. Those same block trade reports show that the entity buying these puts simultaneously sold call options at strike prices of $95, $100, and $810. This is called a collar strategy. They're buying downside protection while selling upside. What does this tell us? It tells us that someone with enormous capital just placed a bet that silver will be lower, not higher, over the next 60 to 90 days, and they're willing to give up all upside above $95 to pay for that downside protection. This isn't a hedge. When you hedge, you buy protection against a small position. These put positions are massive. This is a directional bet. Someone with access to information and analysis that retail investors don't have is positioning for a significant decline in silver prices within the next few months. The third piece of evidence is the most damning. Late Wednesday afternoon, the CME Group, which operates the COMEX Futures Exchange, issued a technical bulletin that went almost completely unnoticed. They announced that effective March 1st, they're implementing new position limit rules specifically for silver futures. The new limits reduce the maximum speculative position any single entity can hold from 9,000 contracts to 6,000 contracts. Why does this matter? Because it forces large speculative long positions to reduce their holdings. Anyone currently holding more than 6,000 contracts, which represents 30 million ounces of silver, has 2 weeks to sell down to comply with the new limits, and according to the latest commitments of traders' data, there are at least 12 to 15 large speculative traders holding positions above that threshold. This is the trap. The exchange just mandated forced selling from the largest, most committed bulls in the silver market. They have to sell. There's no choice. And everyone in the professional trading community knows this forced selling is coming, which means the entities setting up the short positions, buying the puts, and pulling back from collateral markets, they're positioning themselves to profit from the forced liquidation they know is about to happen. The trap has 3 components, and understanding all 3 is critical because this is how retail investors get systematically destroyed, even when the long-term thesis is completely correct. Component 1 is forced liquidation. The exchange rule change forces the largest speculative longs to sell 30% to 40% of their positions within 2 weeks. That's tens of millions of ounces that must hit the market regardless of price. This creates guaranteed selling pressure that has nothing to do with fundamentals or market conditions. It's mechanically required. Component 2 is anticipatory positioning. Sophisticated institutional players who understand this dynamic position themselves in advance. They buy puts to profit from the decline. They reduce their own long exposure to avoid the damage. They prepare short positions or selling strategies to capitalize on the forced liquidation. They're not predicting what will happen. They're positioning to profit from what they know must happen. Component 3 is the psychological cascade. When prices start declining due to the forced selling, retail investors who don't understand the mechanism think something fundamental has changed. They see silver falling from $77 to $70 to $65 and assume the bull market is over. They panic and sell, adding their selling to the forced liquidation, which drives prices even lower, which triggers more panic, which creates a self-reinforcing cascade. This is the trap. The initial selling is forced and mechanical, but it triggers psychological selling that multiplies the effect far beyond what the rule change alone would create. And the institutional players who set this up profit enormously from both the initial decline and the psychological cascade they knew would follow. Now here's what makes this particularly insidious. The rule change itself seems reasonable. The CME can credibly claim they're reducing position limits to prevent excessive speculation and improve market stability. They can point to recent volatility and argue this is prudent risk management. From a regulatory perspective, it's defensible, but the timing is not coincidental. This rule change doesn't happen during quiet markets. It happens now when speculative positioning is at multi-year highs, when the maximum number of participants will be forced to sell, when the impact will be greatest. Someone wanted this rule change implemented at this specific time, and someone is positioned to profit from the chaos it will create. Let me show you the historical precedent for this because this exact trap has been set before in commodity markets, and the results were devastating for those who didn't see it coming. In March 2008, crude oil was in a massive bull market, trading around $105 per barrel on its way to $147. The fundamentals were solid. Chinese demand was growing. Spare capacity was limited. Every analyst agreed oil was going higher. Then the CFTC, the Commodity Futures Trading Commission, announced they were investigating excessive speculation in energy markets and considering new position limits. That announcement alone triggered selling. Traders didn't wait to see what the limits would be. They started reducing positions immediately just in case. Oil fell from $105 to $89 in less than 3 weeks, a 15% decline on no fundamental change whatsoever. Retail investors panicked and sold. They thought the bull market was over. Professional traders who understood the game bought aggressively at $89, accumulating positions from panicked sellers. 2 months later, oil was at $140. The institutions who bought at $89 made fortunes. The retail investors who sold at $91 missed the entire final leg of the bull market. The same pattern played out in silver in January 2011. COMEX raised margin requirements on silver futures by 30%, seemingly out of nowhere. This forced leveraged traders to either post more cash or reduce positions. Many couldn't post more cash. They were forced to sell. Silver fell from $31 to $26 in a week, a 16% decline. Retail investors panicked. They thought the rally was over. They sold at $26 or $27, locking in modest gains and congratulating themselves for getting out before the crash. 3 months later, silver was at $49. The retail investors who sold at $27 missed an 85% move because they didn't understand the mechanism. They mistook forced technical selling for a fundamental change in the market. In September 2019, palladium was trading at $1,150 per ounce in a well-established bull market driven by automotive catalyst demand and supply deficits. The exchange increased margin requirements by 25%, forcing leveraged longs to reduce positions. Palladium fell to $1,250 within days, down 6.5%. Retail investors who had been holding confidently started questioning the thesis. Many sold. 6 months later, palladium was at $2,800 per ounce. The institutions who understood the trap bought at one house darn 50 and made 93% returns in 6 months. The retail investors who sold made nothing. The pattern is always identical. Exchange rule changes or margin increases force mechanical selling. Retail investors mistake the forced selling for fundamental deterioration. They panic and add to the selling. Institutions who understand the game buy from panicked sellers at depressed prices. Weeks or months later, prices are substantially higher, and retail investors realize they sold the bottom. And this pattern is about to repeat in silver right now. The trap is set. The forced selling will begin within 2 weeks, and most investors holding silver will have no idea this is a mechanical, temporary event, rather than a fundamental change. Here's what you need to understand about the psychology that makes this trap so effective. When you see prices falling, your brain immediately searches for an explanation. It needs a narrative to make sense of what's happening. And the narrative it creates is almost always wrong because your brain doesn't have access to the institutional information about forced selling and position limit changes. So your brain creates a story. Maybe the bull market is over. Maybe I was wrong about the fundamentals. Maybe the smart money knows something I don't, and they're getting out. These narratives feel true because they explain what you're seeing, but they're completely false. The selling has nothing to do with fundamentals. It's mechanically forced by exchange rules. But here's the problem. Even if I tell you this right now, even if you intellectually understand that the coming decline is technical and temporary, when you watch your position drop 15% in 2 weeks, your emotional brain will override your intellectual understanding. You'll feel fear. You'll feel doubt, and you'll be tempted to sell to make those feelings stop. This is why the trap works even on educated investors who should know better. The intellectual knowledge that the selling is forced doesn't protect you from the emotional response when you watch your money disappear. Fear is more powerful than knowledge, and the institutional players setting this trap know that and exploit it ruthlessly. Let me show you the specific timeline of how this will likely unfold over the next 4 to 6 weeks. Because if you know what to expect, you're far more likely to hold through it. Week 1, which is right now, the institutional players complete their positioning. The puts are purchased. The collateral is reduced. The short positions are established. To retail investors, nothing looks unusual. Prices are stable around $77. The market feels calm. Week 2, the forced selling begins. The large speculators who must reduce their positions start selling to comply with the new March 1st position limits. Initial selling is orderly. Prices drift from $777 to $73 or $74. Retail investors notice the decline but aren't particularly concerned. It looks like a normal pullback after the recent rally. Week 3, the selling accelerates. As prices decline, it triggers stop losses from momentum traders. The forced selling continues as more large speculators liquidate to reach compliance. Prices fall from $73 to $67. Now, retail investors are getting nervous. This is more than a normal pullback. Fear starts spreading through social media and trading forums. Week 4, the panic phase. Prices fall from $67 to $60, down nearly 20% from the starting point. Retail investors who bought at $75 or $80 are now significantly underwater. The financial media runs headlines about the silver bubble bursting. Technical analysts point to broken support levels and bearish patterns. Retail selling accelerates, adding to the forced liquidation. This is the capitulation phase, where weak hands exit at the worst possible prices. Week 5, the reversal begins. The forced selling is complete. Large speculators are now in compliance with position limits. Institutional buyers who were waiting for this exact moment step in aggressively. They absorb all the panicked selling from retail investors. Prices recover sharply from $62 to $70 in just days. Retail investors who sold at $63 or $65 watch in disbelief as prices recover without them. Week 6 to 8, the recovery completes. Prices return to $77, then push through to new highs at $85 or $90. The institutions who bought at $62 to $60 are sitting on enormous profits. Their put options expired worthless, but they more than made up for it by buying physical and futures at the bottom. The retail investors who sold are now completely out of position, having sold the exact bottom and missed the subsequent rally. This timeline isn't speculation. This is the pattern that has repeated in every forced liquidation event in commodity markets for decades. The specific prices might vary. The exact timing might shift by a few days. But the overall pattern is incredibly reliable because human psychology is incredibly predictable. Now, here's the part that will make some of you angry. But you need to hear it. The silver community, the people on social media and YouTube talking about silver every day. They're not prepared for this. They're conditioned to buy every dip. They've been trained by recent experience that every sell-off is temporary and should be bought aggressively. That conditioning is about to be exploited. When silver falls from $77 to $70, they'll buy, telling everyone it's a gift. When it falls to $65, they'll buy more, saying the fundamentals haven't changed. When it hits $62, they're out of capital and deeply underwater. And that's when the real psychological damage happens. I'm not saying this to mock them or to be contrarian. I'm saying it because pattern recognition based on historical precedent suggests that the majority of current silver holders will exit their positions near the bottom of this forced liquidation event. And that's exactly what the institutional players setting this trap are counting on. So what's the solution? How do you protect yourself from this trap and potentially even profit from it? There are 3 strategies, and which one you choose depends entirely on your risk tolerance and conviction level. Strategy 1 is the conservative approach. If you're currently holding silver and you're not confident in your ability to hold through a 20% decline without panicking, reduce your position now. Take some profits. Get down to a position size that you could watch fall 25% without losing sleep. Yes, you might miss some upside if the decline doesn't happen or isn't as severe, but you'll also ensure you don't panic sell at the bottom of the forced liquidation. This isn't cowardice. This is honest self-assessment. If you know you don't have the emotional fortitude to hold through a 20% decline, especially after watching prices be stable for weeks, then holding a large position is setting yourself up to sell at exactly the wrong time. Better to reduce now than panic sell later. Strategy 2 is the conviction holder approach. If you have high conviction in the long-term silver thesis, if you understand that this forced liquidation is a mechanical event unrelated to fundamentals, and if you're confident you can hold through a 20% to 25% decline without selling, then do nothing. Hold your current position. Don't try to trade around the volatility. Don't try to sell and buy back lower. Just hold. This requires real conviction, not imagined conviction. Most people think they can hold through a 25% decline until they actually experience it. The fear is more intense than you expect. The doubt is more powerful. But if you can truly hold, if you can watch silver fall from $77 to $60 and not sell, you'll be positioned perfectly for the recovery and the subsequent rally. Strategy 3 is the aggressive approach, and this is only for people with strong conviction and available capital. If you understand this forced liquidation is coming and you have cash available to deploy, you wait for the panic phase. You don't buy the initial decline from 70 cents to $73. You don't buy at $70. You wait for the real panic, the move to $60 to $65, and then you buy aggressively. This is what the institutions are doing. They're not trying to catch the falling knife on the way down. They're waiting for peak fear, for maximum panic, for the point where retail investors are capitulating in desperation. And that's when they deploy capital. It requires patience and nerve. but the risk-reward at the bottom of a forced liquidation event is extraordinarily favorable. Now I need to address the elephant in the room. What if I'm wrong? What if this decline doesn't happen? What if the forced selling is absorbed without prices dropping significantly? It's possible. Markets are never certain. But here's what you need to consider. The evidence that this trap is being set is substantial. The repo rate spike, the massive put buying, the exchange rule change. These aren't ambiguous signals. They're concrete actions by institutional players with enormous capital. Even if the decline is smaller than I'm projecting, even if it's only 10% or 12% instead of 20%, the psychology will still be tested. Retail investors will still face doubt and fear. Many will still sell. The trap will still claim victims even if it's not as dramatic as previous instances. And here's the other consideration. If you're wrong about this and you took defensive action by reducing your position or preparing to buy lower, what have you lost? You might miss some upside if silver goes straight from $7,700 to $95 without a correction. But you've protected yourself from a potentially devastating psychological event that could cause you to exit your entire position at the worst possible moment. Risk management isn't about being right every time. It's about ensuring that when you're wrong, the consequences are manageable. Taking defensive action against this trap, even if it doesn't fully materialize, is prudent risk management. Let me show you what this means for silver mining stocks, because the trap in the mining sector could be even more devastating than in the metal itself. Junior mining stocks typically decline 2 to 3 times as much as the underlying metal during sell-offs. If silver falls 20%, junior miners could easily fall 40% to 60%. That level of decline will absolutely break the conviction of most mining stock investors. Watching a position that was up 80% suddenly drop to only up 10% or even go negative creates enormous psychological pressure. The temptation to sell and preserve what's left becomes overwhelming. But here's what history shows. The mining stocks that fall the hardest during these forced liquidation events are often the same ones that deliver the largest gains during the subsequent recovery. The stocks that get destroyed in the panic phase, dropping 50% or 60%, are often the ones that subsequently rise 200% or 300% as the bull market continues. The institutions know this. That's why they're setting this trap. They want to shake out retail investors from mining positions so they can accumulate those shares at panic prices. Then when the forced liquidation is over and prices recover, those institutions make multiples on the shares they bought from panicked sellers. If you're holding mining stocks right now, you need to make the same decision as with physical silver. Can you hold through a 40% to 60% decline in your positions? Be honest with yourself. If you can't, reduce your positions now to a size you can hold. If you can, and if you have conviction in the companies you're holding, then prepare yourself mentally for what's coming and commit to holding through it. The worst outcome is holding positions that are too large for your emotional tolerance and then selling them at the bottom of the panic phase. That's exactly what the institutions setting this trap want you to do. Don't give them that satisfaction. Now let me address the long-term thesis because I don't want anyone to think that identifying this trap means I'm bearish on silver. I'm not. The structural bull market thesis remains completely intact. The supply deficit of 140 million ounces annually hasn't changed. The industrial demand from solar, EVs, and AI infrastructure continues accelerating. The above-ground inventories continue declining. The monetary crisis continues intensifying. Michael Oliver's momentum analysis still shows a structural breakout that projects to $500 per ounce minimum. The fundamentals supporting that target are stronger now than they were months ago. Nothing about the long-term thesis has changed. But this trap, this forced liquidation event that's about to unfold, it's a short-term disruption. It's noise. It's a temporary event that will create a fantastic buying opportunity for those who understand it, and a devastating loss for those who don't. The institutions setting this trap aren't bearish on silver long-term. They're creating an opportunity to accumulate positions at lower prices from investors who don't understand what's happening. Once the forced liquidation is over, once they've accumulated what they want, they'll be perfectly happy to see silver rally to $100, $150, $200 because they'll have massively larger positions bought at much better prices than they could have accumulated without this trap. Think about the psychology of what they're doing. They can't accumulate billion-dollar positions in silver without driving prices higher. Every time they buy, they push prices up, making their average cost higher. But if they can engineer a forced liquidation event through exchange rule changes, they can accumulate enormous positions as panicked sellers dump their holdings. They're using regulatory mechanisms to create buying opportunities that wouldn't otherwise exist. It's brilliant, it's ruthless, and it's about to happen again. So, here's where we are. The trap is set. The institutional positioning is complete. The forced selling will begin within 2 weeks when the new position limits take effect. Prices will decline potentially sharply. Retail investors will panic and sell, amplifying the decline beyond what the forced selling alone would create. Institutions will buy aggressively at depressed prices, and then prices will recover, continuing the structural bull market. But with institutional players holding much larger positions and retail investors having been shaken out at the worst possible prices. This pattern has repeated in every major commodity bull market in modern history. It's happening again in silver right now, and most investors won't realize they walked into a trap until it's far too late to do anything about it. You now have information that most silver investors don't have. You understand the mechanism. You know what's coming and approximately when. You have time to make rational decisions about your positioning before the chaos starts. You can reduce positions to sizes you can hold comfortably through volatility. You can prepare capital to deploy during the panic phase. You can commit to holding through the forced liquidation if you have genuine conviction. But what you cannot do is pretend this isn't happening or assume you'll figure it out when the selling starts. By the time prices are falling and fear is rising, your ability to make rational decisions will be severely compromised. The decisions need to be made now while your mind is clear and emotions aren't running high. The silver market is about to enter a period of orchestrated chaos designed to separate weak hands from their positions. The institutions setting this trap have done this before many times in many markets. They know exactly how retail investors will react, because retail investor psychology is remarkably predictable. Don't be predictable. Don't be the person who panics and sells at the bottom. Don't be the cautionary tale that institutions profit from. Understand what's happening. Position yourself appropriately, and either hold through the storm or wait to buy during the panic. The trap is being set right now. Most investors won't see it coming, but you do. Use that knowledge wisely. Thank you for watching. If this analysis opened your eyes to what's really happening, subscribe immediately for coverage of how this unfolds over the coming weeks. Share this with anyone holding silver who needs to hear it. Comment below with your strategy. Are you prepared for what's coming? I'll see you in the next one.